Okay, good afternoon and welcome back everyone to our options education webinar series. My name is Tony Zhang. I'm the chief strategist here at Options Play, and I'm very excited to start another beginner options trading course for first trade investors. This is the first part of a 4-part series that's going to help you get a better understanding of some basic option strategies that you can deploy for your portfolio. Now, regardless of whether you are brand new to options trading or you have plenty of experience, the strategies that we'll discuss here during the first few sessions will be applicable to pretty much everyone, especially for those of you that currently have experience trading equities. Today, what we're going to talk about is a strategy that largely is an investing strategy and not a trading strategy. This is for the stocks and ETFs that you hold in your portfolio that can allow you to generate some additional income and allow you to take profits on the stocks and ETFs that you hold utilizing an option strategy. And it's really a strategy that you should be thinking about as a comparison to something that you're already doing with your equity portfolio. So today we're going to spend some time talking about covered calls. I'm going to dive into the strategy, make sure that you understand conceptually how the strategy works, and then more importantly, show you how you can screen for opportunities using a covered call screener. So before we get started, what we're going to discuss here today is purely for education and demonstration purposes. It is not a solicitation or recommendation to buy or sell any specific securities. So we'll start off today with just defining what is a covered call for those of you that are relatively new to this strategy and want to learn. Then the best way to learn is always to use a real example. So we're going to show you an example of a covered call and the different outcomes and how we determine what we call the optimal cover call, meaning what expiration date, what strike price do you choose? That's probably the most common question that we receive with respect to these types of strategies. So we'll discuss what the optimal cover calls are. Then we'll take a look at the income reports that you have access to at First Trade that will allow you to take what you've learned here today and apply them to the stocks and ETFs that you might hold in your portfolio. Then we'll talk a little bit about trade management. Once you're in a cover call, how do you manage them? And then go through some live examples before answering your questions here at the very end. But the primary question that I want to help investors answer from today's session is how can I generate additional yield on a portfolio using covered calls? Now, like I said, this is a webinar for those of you that are investors, not for traders, and because covered calls are an investment trading strategy. So my name is Tony Zhang. I'm the chief strategist at Options Play, and I'm here to teach you these types of strategies and best practices so that you can learn how to apply them in your own portfolio here at First Trade. Now, before I get started and jump into a cover call, I want to ask the audience a question. So if you could please bring up your chat window, which is at the bottom of your screen, and please type 1 into the chat window if you currently invest in stocks or ETFs, meaning you hold stocks or ETFs in your portfolio. Type 1 if you own stocks or ETFs in your portfolio. Okay, I see a lot of ones. Now, how many of you currently trade options? Type 2 if you currently trade options in your portfolio. Okay, so I see a fewer number of 2s in terms of those of you that are trading options in your portfolio. And how many of you are just in the process of learning how to trade options? Please type 3 if you're just learning how to trade options at the moment. Okay, I actually see far more 3s than I see 2s, meaning those of you that are in the process of learning how to trade options. So first of all, for those of you that are learning, welcome. That's exactly what we're here to do today, is to provide you with some education, and more importantly, education that you can actually implement after you finish today's session. So let's go ahead and get started. Like I said, a cover call is a strategy that is suitable for anyone with a stock portfolio, a stock or ETF portfolio, and many of you answered 1 as investors in stocks. So what is a cover call strategy then when it comes to options? A cover call strategy is really a strategy for the stock positions that you hold in your portfolio. What we're doing here is we're selling a call option against a stock position that you own in order to generate income on an existing stock position. Now, that is, I think, why most people are interested in selling cover calls, is because they're interested in the income feature, if you will, of a cover call. However, one of the things that you're going to see as you go through the learning today is that I actually think that the income piece is secondary to the primary piece, which is the fact that you own your stocks in your portfolio, not because you want to generate income on that asset. You own those assets because you believe or you want that asset to increase in value so that you can profit from that, right? That's truly the reason as to why you own a stock in your portfolio. So what we're going to show you is how selling a cover call allows you to potentially sell your stock or ETF at a specific price, because ultimately we own our stocks because we want to sell it later at a higher price and make a profit. That's why we own those stocks. Otherwise, we really don't have a good reason to hold on to those stocks. Otherwise, you have other asset classes that you might want to trade, like a bond or other asset class, if you're simply looking for income. So that's why I tell investors, when you're looking at a cover call, don't think of it as an income generating strategy. Think of it as a strategy that allows you to put a target price on the stocks that you own, and so that hopefully as the stock rallies up to that price, you're able to take profits on that rally. And then in the meantime, while you wait for that to happen, if you get paid some income, that's great, but that's not the primary reason as to why you should sell covered calls, okay? And as we go through the examples, things will make a little bit more sense. But this is a strategy that requires at least 100 shares of a stock that has options on it in order for you to trade the strategy. And the reason for it is because every time you sell a cover call, it obligates you to sell that particular stock at a specific price. And each contract that you sell is obligating you to sell obligates you to sell 100 shares of that stock. Now, you can't sell stock that you don't have, which is why you must own at least 100 shares of an underlying stock before you can sell a cover call. So that's one of the limitations here of selling cover calls. You cannot do it on stocks that you own 10, 20, 50, 99 shares of. It has to be at least 100 shares of, and you can only do this in 100 share increments. So if you have 150 shares, you can only sell a cover call on 100 of those shares. So the other 50 shares are not technically covered. Does that make sense, everyone? Please type 4 into the chat window if that makes sense to you. And if you feel a little lost here at this moment, that's okay. We're going to go through some more. I'll go through a real example, and that's going to help solidify perhaps some of the questions that you have, and we will have Q&A here at the end. So let's first start. Let's look at Seagate Technologies, right? It doesn't really matter what stock we look at. This is just for an example. The stock is currently around $88.60 or so. And maybe you think the stock is going to go, maybe you own the stock because you think the stock is going to go higher, right? So let's say I currently own 100 shares of Seagate Technologies. I own it at $90. And let's say I have a target price of $100. So I own it at 90, and I think the stock is going to rise to 100, and I would like to take profits when the stock rises and rallies to my $100 target. So as an equity investor today, for those of you that own stocks, and many of you said that you do, many times you have a target price on that stock. What do you do as an equity investor? There's really only one thing that you can do, is you put in a sell limit order at the price that you think the stock is going to hit, and then what you do is you sit there and you wait for the stock to hopefully rally to the point that you set as a price target, and when it does, it triggers it, and you are able to take profits. In the meantime, what your risks are $90 a share, the price that you purchase it for. If it plummets to zero before it hits your target price, you're risking $90 per share. Your potential risk is $10 per share, the difference between your target price and your cost basis. And you effectively have exposure to the swings of STX going higher or lower and collecting dividends between now and the time that your order is triggered, meaning if the stock reaches $100 and you're out of the trade. Does that make sense, everyone? Please type 5 into the chat window if that makes sense to you. This is pretty straightforward so far with respect to the stock part, because any of you that have traded stocks, you've probably put in a limit order to sell your stock at a specific price, okay? Until the stock hits that price, you have exposure and you can collect dividends. That's the only income that you have between now and the time that your order is filled. Now, let's flip over to an options trader, right? Same goal. I own the stock at $90. I think I want the stock to reach 100. That's my target price. And what I'm going to do as an options trader, instead of placing a limit order to sell my stock at 100, what I do is I sell, let's say, a $100 call option that expires in August. Now, the difference between the two are actually quite similar, because when I place a limit order, I'm obligated to sell the stock once the stock reaches $100. That's what a limit order obligates you to do. When I sell a call option at, let's say, $100, I am also obligated to sell. In this particular case, each contract that I sell obligates me to sell 100 shares of this particular stock at $100. But the difference between a limit order and a cover call, or a call option in this particular case, is that a call option, I get paid to sell that call option. So I effectively get paid to take on the same obligation as someone who places a limit order. The difference between a limit order and a call option is that the limit order allows me to create a limit order for any number of shares. For a call option, I must have 100 shares before I can obligate myself to sell the stock at $100. Does that make sense, everyone? Please type 6 into the chat window if that makes sense to you. So you have some limitations with the call option, but you have the same obligation. And for that obligation, the call option pays you premium. In this particular case, it pays me, let's say, $1 per share to obligate myself to sell the stock at $100. So multiply that by 100 shares, that is the equivalent of taking in $100 of income. So imagine placing a limit order and then getting paid $100 in income for obligating yourself to selling the stock at $100. That is effectively what is happening when you sell a cover call. Now, the end result here is that once I sell a cover call, because I collect $1 on that call option, my risk is now reduced from $90 a share to $89 a share. Because my cost basis is $90, I'm now taking in $1 in premium, my risk is reduced to $89 a share. On the flip side, my reward is increased, because now the differential between the price that I sell it for and my cost basis is now $11. So what happens is my risk is reduced and my potential reward is increased. And during this time, while the stock attempts to rally to $100, maybe it goes higher, maybe it goes lower, none of us knows where it's going to go. But as the stock fluctuates in price and potentially increases or decreases, I can collect dividends on the stock if it's a dividend-paying stock, but I also generate income from the cover call. Now, a limit order like this can sit there for weeks, for months, perhaps even for years. A call option expires. Once the call option expires, I have the choice of selling another call option, effectively putting myself back into the same obligation and collecting more premium. So what you see here is that for this 1 month time frame between July and August, I'm collecting $1 in premium. If, let's say, by August the stock is not above $100, your limit order would just be sitting there. My cover call would expire, I would keep my $1, and I would continue to be able to sell another cover call. I'd be able to sell a September cover call, an October cover call. As long as the stock does not exceed my target price, I can keep selling cover calls and keep generating the income until the stock reaches my target price and I effectively sell my stock at the $100. So that's the difference between a limit order and a cover call. So the result here is the fact that I'm going to have a lower break even on the stock price, because from the more premium I collect, the lower the break even cost on my stock is. And I generate, in this particular case, at least $1 extra in profits from selling just a single cover call. If I sell multiple cover calls, I'm going to collect more premium, which will equate to extra additional profits. So in this particular case, I'm going to make in a single month effectively 1.1% in additional profits, or 1.1% in additional income. Now that doesn't sound like an earth-shattering amount of income, but I will show you here in a few seconds with some real examples just how much that really adds up to, because you have to also consider the amount of time. 1.1% in 1 month's time, multiply that throughout the multiple months throughout the year, that can add up to be quite a bit of income, especially when you compare it to the dividend yield that you're collecting on many of the stocks that you own. Does that make sense to everyone? Please type 7 into the chat window if that makes sense to you. And keep in mind, these sessions are recorded, so if this is the first time you're learning about this and you need to go back and you feel that I'm going through these things a little too quickly, you have the ability to go back and watch these things at your own pace so that you make sure that you understand each component piece by piece. So the question from many investors becomes, well, okay, I understand this concept. I can sell a call option sometime in the future that obligates me to sell the stock at a specific price, but how do I go about choosing the expiration date and what price I want to sell the stock at? That's really truly at the core of the decision-making process, the tricky part, right? Which expiration date do I choose? Meaning, how long do I want to have this obligation for? And at what price am I comfortable enough to effectively allow my stock to be called away? So in this particular example, Seagate Technology at the time was trading at $88. This is the stock price, right? The stock had a pretty sharp rally up to close to $100, pulled all the way back to 85. It's now at 88. Maybe you think the stock is now going to continue to rally. So I have a few different choices for you, and I want to canvas the audience here as to what you think is the optimal cover call. Now, I'm going to first make this easy for you. I'm just going to outright tell you the optimal cover call from a time frame perspective is 45 days to expiration. I'm not going to spend today's time to really get into the math behind that, because this is based on years of back testing. We have back tested cover calls for just about every single possible expiration date. If anyone has some questions, I'm happy to answer this during the Q&A section, but we've basically back tested all of the different expiration dates, and 45 days is the optimal starting point when it comes to selling cover calls. So I'm going to leave it at that. Let's just talk about the strike prices, right? So let's just say I'm going to give you a few choices: 95, which is around right here, 97.5, and 100, right? So these are the three choices that you could have. You can basically obligate you to sell your stock at 95, 97.5, and $100. So when you sell the $100 strike price call, you collect 75 cents in income. You sell the 97.5 call option, you collect $1.05 in income. You sell the 95 calls, you collect $1.50 in income. So this translates to $75 per contract, $105 per contract, or $150 in income, which is these particular returns: a 7% return, a raw return, meaning a return of 0.84% in 45 days. If you annualize that over the year, that comes out to be 7%. 1% over 45 days, which annualizes out to just shy of 10%, or $1.50 comes out to be 1.53% in 45 days, which annualizes out to 14.56%. So I asked the question here to the audience: if you had to choose a cover call for your portfolio, which one would you choose? Type it into the chat window: the 95, the 97.5, or the 100s. Okay, I see a lot of answers for 95s, a lot of 97.5s, a couple of 100s, but it seems like predominantly most people would choose the 97.5 or the 95. I do have quite a few people who have selected the 100s, okay? Now, I tend to find that when I ask this question, most people tend to answer the 97.5 or the 95s. And most people answer this based on these numbers over here. An annualized return of 10%, annualized return of 14.5%. That certainly sounds a lot better than having an annualized return of 7%, right? Who would choose 7% when you can have double that at 14.56%? Now, this is really where our backtesting over and over again, over tens and tens of thousands of trades, lead us to the answer, which is the fact that the $100 strike price that collects the least amount of premium or the least amount of income, here in this particular 7%, is what's going to actually yield you the highest return in the long run. And why is that? It's because if you select, let's say, the $95 strike price and you collect $1.50 and you effectively collect double the amount of income, and you're thinking to yourself, that's the way to go, I want to maximize income. What you forget is what you're giving up in exchange for that extra income. So let's say you choose the 95 strike price, and the stock one day rallies up to, let's say, on some good news, or over the next few weeks, there's a really strong bull market, and the stock rallies up to 105. What happens when you put a limit order at 95 or you sell a cover call at 95? It doesn't matter how much the stock goes up by, you sold your stock at 95, which means that any potential gains above 95, you do not get to keep, because you wanted the extra 75 cents in income to get the highest amount of income. For basically 75 cents, you've sold off any potential gains above 105. And what we see over and over again is the fact that when investors choose cover calls just based on income, what they're constantly doing over and over again is giving up potential upside that they're simply going to miss out on. Because think about it, why do you own a stock? You own a stock because you think it's going to rally. And what you're doing when you select a cover call down here is you're effectively saying, I don't think it's going to rally, and I'd rather take an extra 75 cents in income in exchange for that. And you're certainly free to do so, and many times many investors do. But in the long run, what we see is that sometimes you're going to see big rallies in the underlying stock that you're simply not going to participate on, and what you're doing is you're giving up, in this particular case, $5 in the upside of the underlying stock in exchange for 75 cents in income. And that is an equation that doesn't work for you in the long run. Does that make sense, everyone? Please type 8 into the chat window if that makes sense to you. If this is confusing to you, the one thing you need to remember is that extra income that you collect by selecting a lower strike price does not offset what you're going to lose on the upside of the underlying stock if you choose a lower strike price. Okay. And as you go through more of these examples, I encourage you, and especially if you start to trade these cover calls, I encourage you to come back to the recording of these sessions, because once you go through doing it yourself and maybe sold a couple of cover calls and you come back to these education sessions, things will have a new meaning to you and things will click in a different way. So think of these as kind of an ongoing session for you to learn, but be able to come back to later and better understand how these apply to you. So there was a question before, is what is delta? 15 delta, 25 delta, 30 delta? And that's a really good question. Delta is another way for us to express strike prices. So these are absolute prices, 95, 97, 100. These are all numbers that we can see on the chart. But what we cannot see is probabilities. And this is really what our research shows, is that you should choose your strike prices not based on absolute price of the stock, but based on the probability of the stock being above the strike price at expiration. So when you look on your options chain, when you're selecting your strike prices, you're going to see that next to each strike price, there is a metric called delta. And what delta approximates is the probability of the stock being above that price at expiration. So when the 95 has a 30 delta, what that's saying is that there's about a 30% chance that this stock will be above 95 at expiration. the 97.5 with the 25 delta means that there's only a 25% chance that the stock will be above 97.5. And the 100 has a 15 delta, letting you know that there's only a 15% chance that the stock will be above $100. Basically, the further away you go, the lower the delta, because the lower the chance that the stock's going to be above that price by expiration. And what we find is that time and time again, in order for you to have a consistent income stream from selling cover calls, you want to use delta to select your strike prices. Because if you use the 15 delta strike price every single time, then you're going to know that 85% of the cover calls that you sell, you're just going to keep the income from that and just keep doing it over and over again. Only 15% of the time will the stock have a strong rally, and you're going to be able to participate on most of that rally. You're not giving up most of those gains because you're not selling this 95 strike price and losing out on all of these gains. Only when the stock has a very large gain are you not only going to take advantage of it, but the other 85% of the time when it doesn't happen, you're going to collect that 75 cents. And that 75 cents, while pales in comparison to the 14%, but as you can see here, you're only earning 3% per year owning the stock, but you're generating a 7% yield from selling cover calls. So you're more than doubling your dividend yield on this particular stock. That is really the comparison that you should be making when you think about income, is how much income am I collecting on the stock and how much am I collecting on the cover call? Most of the time, you're going to see that cover calls will generate double, sometimes triple the dividend yield. And while, again, 7% is certainly less than 14%, but most investors should be pretty happy to effectively triple their dividend yield by adding this type of strategy. And I always tell investors, this is investing strategy. This is not a trading strategy. So keep that in mind when you're thinking about these numbers. Does that make sense? Please type 9 into the chat window if that makes sense to you. So when you're thinking about your cover calls, don't think about specific dollar amounts. Think about deltas. Think about probability. Think about what is the probability I'm going to keep this income? What is the probability I'm going to earn 7% yield in addition to the 3% that I'm already receiving from owning the stock? And then in that 15% chance that the stock makes this huge rally in the next month, well, guess what? I'm okay taking advantage of that and taking profits, because that's the reason you own the stock to begin with, is because you think it's going to rally and you want to be able to take profits on those rallies. And that's exactly what a cover call allows you to do, is take profits when the stock makes effectively what is an outsized move. And then when it doesn't make outsized moves, you're basically doubling, tripling the dividend yield of that underlying stock. So that is the best way that I want to explain cover calls to investors. It's not really this income generating strategy. It's far more than that. It's a little bit more nuanced, but it's really a very powerful strategy for investors. Okay, so that is how a cover call works. Now, the question for many investors is, how do I apply it to my portfolio? Well, that's really where First Trade and Options Play have built tools for you that helps you do this work for you. We've created what we call the Cover Call Income Report. What we do is we scan all S&P 500 stocks and very liquid ETFs. So if you own stocks that are within the S&P 500 or some of the very liquid ETFs, we update a cover call report for you every single week, and we sort it based on the highest annualized return for you. And what we do is we provide you with the symbol. We also provide you with the expiration date, the specific strike price, how much premium you're collecting, what the annualized return is, what the raw return is, and everything that you need in order to understand how to utilize this strategy. So here is the live report. This was generated on July 1st. The next report is going to be generated tomorrow. I'm sorry, it was generated. Yeah, it's going to be generated tomorrow. You get these reports every single Friday morning for you. You get it as part of your options newsletter. And what it does is it lists every single stock based on the annualized return of the cover call. So I'm going to look down this list of some stocks that I think are widely held. Well, I mean, BlackBerry, perhaps many of you may own BlackBerry. Let me find something that I think is perhaps a little bit more widely held, that most of you probably have in your portfolio. You know what? I think, a really popular stock these days has been Cleveland Cliffs. I don't know how many of you know of this stock, but it's a stock that is, they're one of the largest steel producers here in the US, Cleveland Cliffs. So what I'm going to show you is options play. This is the tool that you have access to free of charge as part of a first trade account. You can access it by going to your home screen and scrolling down. You see this launch section here on the right hand side. You can click on that to launch the options play screen. You can also launch it from the options chain. You can also launch it from the options research tab. There's a few different ways that you can access it, but once you click on that link, it will bring up options play. And what you can do is you can type in the symbol that you're looking for. In this particular case, let's say we're looking at Cleveland Cliffs. Cleveland Cliffs is currently trading at $21.39. And today what we're going to do is we're going to focus on the income tab. The income tab is where you can find the cover call opportunities. And you can use this cover call report, and you can see that Cleveland Cliffs is sell to open the August $29 strike price, which will collect in this particular case 65 cents in premium, or $65 for every 100 shares of Cleveland Cliffs. So let's look at that. We'll modify the cover call. We're going to change it to the August $29 strike. And as you can see, currently it collects about 56 cents in premium. This report was generated last Thursday, so this is just regenerated. You'll get the latest report tomorrow morning. So when you log in tomorrow morning, you'll see this updated report. I will include this link into the chat window for those of you that want to access this report. And what you'll see here is that Cleveland Cliffs, if I own this stock, currently pays 0 dividends. And here, what I'm collecting is 2.62% of the underlying stock price in just 45 days. So in 45 days, I'm earning 2.62%, which if you annualize out to the full year, comes out to be 21%, which obviously is yield that you have none of if you own this particular stock. So here's an example of how you can maximize income for your portfolio. What you do is you go to the cover call report and you effectively go down the report and look for the stocks that you own. So let's say someone else said they own NEO, and I know this is probably a very widely held stock. NEO currently telling me to sell the August $70 strike. NEO is also a stock that does not pay dividends. So if you hold the stock, you have no income to show for it. But I can sell the August $80 strike price, which will collect 35 cents, which sounds like nothing in this particular case. Hold on, was it the 80? No, 70, sorry. That's wrong strike price. 70-cent strike price, which will collect 60 cents, which doesn't sound like a lot. It's $60 for every one contract. So for every 100 shares, which would cost you about $4,600, you're going to collect $60 in income every single 44 days. That doesn't sound like a whole lot, but that annualizes out to 10% on a stock that pays 0 dividends. So you're basically saying that, well, if this stock rallies between now and August, right? And keep in mind, 70 is all the way up here. Let me zoom out here for you. $70 is all the way up here. I think most investors would be pretty happy if in the next month or in the next 44 days or so, NEO is above $70 and you're able to take profits on that big move. And if the stock doesn't make that big move in the next month, well, you're going to earn 10.81% yield while the stock fluctuates up or down, up or down. And when the stock, at some point, the stock makes a big move here to the upside, you're able to take profits on that underlying stock. But that is the core of this strategy. It's It's really not that difficult to understand. You're basically waiting for the stock to rally. And what you're doing is you're adding income to the stocks that you own in your portfolio. The only limitation is that you can only do it on stocks that you own at least 100 shares of. So the cover call report also gives you the current stock price. So for those of you that are interested in this type of strategy, you can purposely look for stocks that are lower price. Generally speaking, Tesla, it's going to be difficult because you need $68,000 to own 100 shares of Tesla. But if you're looking at a stock like BlackBerry, $12 stock. Looking at Plug, $34 stock. These are some pretty popular stocks that a lot of you own. Cleveland Cliffs, $21 stock. Xpeng, $47 stock. So these are stocks that you need $2,000, $3,000, $4,000 in order to own 100 shares of, and that is the minimum that you need to deploy this type of strategy. And as you can see, there's plenty of stocks in this particular range of $20, $30, $40 that you can sell cover calls on if you have a smaller account. And then if you do have a larger account, the higher price stocks, the $100, $200, $300 stocks are obviously going to be within your realm. So this report is designed to help you quickly identify stocks that are yielding a high amount of raw return or a high amount of annualized return so that you can quickly identify which stocks have opportunities for you to sell a cover call on. And while you wait for the stocks to rally, you're going to be able to sell your stocks. And Kyle is asking a great question. Are you guaranteed to have a buyer when you put shares up for a cover call? Yes, Kyle, that is the obligation of the OCC and the clearinghouse of options, is that for every buyer of the option, you are the seller of the option, and any buyer of the option is obligated to buy that stock if the stock is above that specific strike price at expiration. So at this point, what I'll do is I'll return back to the slides, and I want to go through one last thing before we open this up for Q&A. Is once you sell a cover call, so let's say you do exactly in this example as we do, we sell the $100, the August $100 cover call, and once you're in that call option, what can happen? The stock can either rally substantially, it can move sideways, maybe a little higher, a little sideways, a little lower, or the stock can plummet, right? Those are really the opportunities. Those are the possible scenarios that can play out once you've sold that cover call. So what I want to do is I want to cover 3 scenarios and basically what you can do in these types of scenarios. So in the first scenario, if the stock rallies significantly, really, there's not a whole lot that you need to do. First thing you want to do is you want to hold your position if the stock rallies significantly. Now, for some investors, what happens is, at this point, when you enter the cover call, right, you're thinking to yourself, I'm happy selling the stock at $100. If it reaches that price, I'd like to get out of the trade. But sometimes, some more information comes out after you've sold the cover call. So let's say you sell this $100 cover call, and 2 weeks later, you learn that Seagate Technologies, made an acquisition that is really good for its company, or they just reported earnings and it's coming out better than expected, or their company just provided guidance, and you're thinking to yourself, oh, well, and not only do I think the stock's going to reach 100 right now, I think this could be a $130 stock going forward, right? So new information can always come out, and you can say to yourself, well, initially my price target of $100 I was happy with, but now I think there's a new price target, right? And the stock maybe rallies off of it. So this is really where you have the choice. You either are happy to let the stock sell at $100, which is the original decision that you made. In that particular case, you do nothing. You just simply hold on to that position at expiration. Your stock will sell at $100. You walk away from the transaction with a profit on the stock and the income that you receive on the cover call. But like I said, sometimes new information comes out. You have different view now. You think the stock's going to hit 110, 120, 130. In that case, what you do is you have to roll your cover call. What that means is that you have to buy back the call option that you've sold, And what you have to do is you have to sell a new cover call at a new strike price. So this is what we call a roll, where you buy back the call that you sold and you sell a new call at the same time. So some people get confused by the rolls. Don't be. It's really simple. You're just trying to trade two transactions in a single trade. That's all a roll is. But if you need to roll because you now have a new price target, you want to wait until about 2 weeks from the expiration date before you initiate that roll. You don't want to initiate immediately. Sometimes you sell a cover call and within a few days, the stock rallies significantly higher. Don't roll yet. You want to wait towards the last 2 weeks before expiration. Then you want to roll. Buy back the call, sell a new call. In the second scenario, if the stock just moves sideways, slightly higher, slightly sideways, slightly lower here, this is really where you don't have to do anything. You simply hold the position until expiration, or if you want to roll it, you want to roll it 21 days from expiration, either one. But in this particular case, for those of you that are brand new, just simply hold on to it, let it expire. For those of you that have a little bit more experience, you might want to roll it to continue to generate income here on this particular trade. But that's a more advanced strategy. For those of you that are beginners, just simply hold it to expiration, and then once it expires, you can sell a new cover call. And then in the last example, what happens if you sell a cover call and the stock plummets? This is really the only time where it makes sense to do anything early or do something immediately. And this is where you want to roll down your cover call. So this is really where you might want to, instead of now, let's say the stock is down to 80. Originally, you sold a $100 cover call. Maybe you might want to adjust it now to 95, right? Wait for a new rally up to 95, which is still going to be a big rally. But the rule of thumb here is that if you're able to buy back a cover call at 20% of the original premium, so let's say you sell a cover call for $1, so you collect $100 in premium. And now you can effectively remove that obligation by paying just $20 or 20% of the original premium. That's when you want to roll a cover call early. So you basically are collecting $80 of the total profit potential effectively immediately, and then you can sell a new cover call and collect another $100 over the next 45 days. But the rule of thumb here is just only buy back a cover call if the stock plummets, and you can buy back the call for less than 20% of the original premium. So that covers what I wanted to share with you here today. Like I said, I hope that this was helpful in giving you a better understanding of cover calls and the mechanics of selecting an expiration date and strike price and the different scenarios that can play out here. For those of you that are brand new, I don't necessarily expect you to be able to walk away from this and just start trading this, but I do want you to be able to start playing around with the cover call report, which I, again, will send a link to you in the chat window. Bring up options play so that you can type in a symbol that you're interested in. Let's say you are interested in, I don't know, I'll just do one last example. Let's do Snapchat. Let's say you like Snapchat or you own Snapchat. This is telling me to sell the August $85 strike price. So let's take a look at the August $85 strike price. Remember, click on the income tab when you go into options play. And then when you click on the modify button, we'll go to August 80, I think I said 85, right? That will collect $1 in premium, which is 1.54% of the stock's value in 44 days, which annualizes out to 12.73%. Compare that to the fact that the stock pays zero dividends. And looking on the chart here, where is 85? 85 is all the way up here. So in the next 45 days, if the stock rallies up to $85, great. I get to take profits on this huge rally. And the other 85% of the time when that doesn't happen, guess what? I get to earn now a 12% yield on Snapchat while I wait for the stock to rally, because that's the reason I own this particular stock, is because I want it to rally. I believe it will rally. So while I wait for that to happen, let me at least add, in this particular case, 12% in yield. And then when it does happen, that 1 month where maybe earnings comes out and the stock jumps, I'm actually able to take profits on that using this strategy. Does that make sense, everyone? Please type 1 into the chat window if that makes sense to you. Okay, perfect. So that covers what I want to share with you here today. Let's open this up for Q&A. If you have some questions, there's a Q&A section here at the bottom of your screen. I have about 15 minutes or so here to answer some questions, so please type your questions into the Q&A section. I'll try to answer as many questions I have time for before I have to jump off here for today. I do see one question from Joseph asking, where do you see delta? So within options play, when you click on the modify button, within the strike prices, there are three lines. You have your strike price, you have your premium, meaning how much income you're going to collect, and you have the third number, which is delta. So 0.11 means 11%, 0.19 means 19%. So you can use this to help you select your strike prices based on probability. So if I select a 77 strike, I know I have a 22% chance that the stock will be above 77. If I choose the 85, I know there's 11% chance. In this particular case, based on the current price, I might choose the $80 strike, which means that there's about a 17% chance that the stock will be above $80 at expiration. Is there a way to start options trading on a stock that doesn't have options? No, you cannot trade options on stocks that are not yet optionable. Only stocks that are optionable can you trade options on them. Can the 100 shares that are used for cover calls be also used in the limit order? No, you cannot. So once they are covered, you cannot sell. I take that back. You can put a limit order, but understand that if that limit order is triggered, then you are left with effectively still the same obligation to sell your stock at that specific price, and you don't actually own the stock to sell that strike price. The OCC is going to require you to post margin in order to have a naked call. Not to mention, your brokerage firm may not allow you to have naked calls, which would then trigger a margin call. So I do not recommend that you have a limit order and a cover call on the same stock, or on the same 100 shares rather. If let's say you have 200 shares and you have a limit order on 100 shares and you have a cover call on the other 100 shares, that is perfectly fine. Should I still roll the cover call 21 days to prior expiration for a credit? So Michael, you can. It's not necessary. It's really up to you. The difference between the two strategies, holding to expiration versus waiting 21 days to expiration, the 21 days to expiration is really more so for investors who are just interested in income and not interested in selling the stock itself, because some investors just want the income, right? You're not really using this as a way to take profits. Maybe you just have a long-term view on the stock and you want to hold on to a long-term. That's when you want to use the 21-day rule. Otherwise, you can hold it to expiration. Do you need to put a sell limit to the stock that you own, or does it get automatically sold at your cover call target price? You do not need to set any limit prices. Once you sell a cover call, that's all you need to do. Can you please explain again what it means to buy back a 20% of the original premium? I would recommend for that particular question to watch one of my recent videos, which is entering option orders and managing positions on this page, because in that video it will explain to you what I mean by that, because I think for that question to be answered, you need to understand buying and selling options, and entering option orders and managing positions will help answer that question, Andrea. Can I watch the video again? Yes, these are all recorded, and these will be posted at the link that I just shared with you in the chat window. Who decides if a stock is optionable? The exchanges do, and it's really based on a set of rules that they have in terms of the amount of volume that the underlying trades in. The market cap, generally speaking, are the factors that determine whether a stock is optionable or not. What happens if no one buys your contract? So Gary, that's not how this works anymore, right? So there's no, they're effectively market makers. Their job is to buy and sell from you. So there really isn't a world anymore where there's no buyer or seller for a contract. There's effectively always a buyer or seller for a contract. The question is, what price are you able to buy it or sell at is really the question. There will always be a buyer. That's what a market maker is obligated to do. So you won't ever have that problem. The question is really, what price are you able to buy or sell a contract at? That is the question. What is the treatment of a debit premium? So Lonnie, I think the best person to ask for this is your tax professional. It depends on the type of account that you're trading in and your holding period. How can we get to the cover calls report in First Trade platform? So I sent the link into the chat window before. Let me send it to you again. I just sent it into the chat window again. Can you see how see how to buy a call or put option, but how do you then sell that option? So Gabriel, same thing. I suggest that you watch this video, Entering Option Orders and Managing Positions. This is where we show you the mechanics of entering and closing positions, and we also do a few demos using the First Trade platform to show you how to do it on both the mobile and desktop video. If I want to establish position or create income by selling a put option, does a 45-day rule work here as well? So I'm actually going to be talking about short puts next on our next session in 2 weeks. So I will dive into the details of that. But to answer your question, yes, the 45-day rule does apply to short puts as well. Are options trading taking into account for the pattern day trading rule? Yes, they are, unless you're trading in a cash account. But yes, day trades and options do count towards your pattern day trading rule. I will say options are, generally speaking, you generally don't day trade options, simply because transaction costs are pretty wide or or significantly higher in options. So that's why it's typically not a vehicle that you buy and sell intraday. Thank you so much. I really appreciate those of you that said that I'm an excellent teacher. I appreciate that. The video that explains my question about the 20% back of the original premium, that is this: Entering Option Orders and Managing Positions. Is there a cost when doing an option? The only cost to trading an option is the transaction cost between the bid and the ask price, which is the same as when you trade a stock. The difference between the buy and the sell price, that is your only transaction cost. There are no commissions and fees to trade options, if that is your question. Irene, thank you so much. I really appreciate that. Just saw some information on First Trade about 50-cent options. Just wondering what was that about. Not sure what you mean by 50-cent options. 0 commissions and 0 option contract fees at First Trade. Do I set the ask price? So you set your limit order price. You do not set the asking price unless your limit order is inside of the bid ask. Do you become, effectively the asking price? But you are putting in a limit order. You're not necessarily putting in an asking price. Jim, thank you so much. I really appreciate it. First Trade does not charge any fees on trading options. That is correct. Your only fees are the difference between the buy and the sell price as determined by the market. First Trade does not charge you any additional fees on trading options. Alman, you're very welcome. Virginia, you're very welcome. Thank you. Morgan, Andrea, I appreciate it. Any other questions? Is there any advice in the report about index options? Well, you can't sell a cover call on an index option because you can't own the index. You can own an ETF that mimics an index. So yes, the report does cover ETFs. So for example, if you own QQQ to mimic the NASDAQ 100 index, then yes, you can use the report for selling QQQ cover calls. But because you can't own an index, you can't sell a cover call on an index. I think the premium was 50 cents. I was trying to reread before next session. Gabriel, I'm not sure I understand your question. Raul, Armin, Candy, Lonnie, thank you so much. I appreciate it. I have had options that on expiration date, Friday close of the market, the stock was a few cents above the strike price, but it did not execute on Monday. The stock was way down. Can the market maker pick and choose which options to execute after the expiration date? The market maker does not choose which ones they execute after the expiration date. The buyer of the option is the person who chooses, right? So if you're the seller, if someone else is the buyer, that buyer is the person who chooses whether they want to execute. That's your option as a buyer. As a buyer, you have the option. So when we refer to options, that is the literal translation of why it's called an option. Because as a buyer, you have the option to exercise the option. You don't have the obligation. You have the option to do it. So the buyer always has the choice. Whether the stock is above or below the strike price, they have a choice of whether they want to execute or exercise the call or put option. What are other reasons to roll the cover call? Really, the only reason to roll the cover call is because you don't want to lose the stock, and you think the stock can keep going higher and higher. That's really the one reason that you want to roll the cover call. Great session. Can you do cover calls in a Roth IRA? And does the income go into your Roth IRA if the cover call doesn't sell? Gary, yes, you can sell a cover call in a Roth IRA, meaning a Roth IRA in itself does not preclude you from selling cover calls. I don't know the rules specifically at First Trade within the Roth IRA. That's a question that I think you should direct at First Trade customer service. They'll be able to answer that question. But yeah, you should be able to sell cover calls in the Roth IRA. Why would a buyer of an option buy an option with a very low delta? So Kyle, market makers don't really care what delta of an option is because they will just hedge their risk with buying of the underlying stock. So when I think this idea of buyers and sellers is still a bit of an old school view of how buying and selling works. There isn't actually just another person who wants to happen to take the opposite side of the trade on your behalf. A market maker does it because that's their job. And once they buy that very low delta trade from you, they immediately hedge their trade by just buying some stock. That's all they need to do. So you have the risk of being the short the option. They don't have the risk on the other side as the buyer of being long that option. So that's why it's not factored into the decision-making process to why someone would buy a low delta option. What is the last time an option can be exercised? It can be exercised about 30 minutes after the close on expiration date. So on Friday, I think most brokerage firms give you to about 4:15, 4:30 to do that expiration. I'm sorry, that exercise. Some firms, may give you 45 minutes, but it's usually right after the close. Is a short put the same as a cover call? It is not the same. They are very similar in nature in terms of risk profile, but they are quite different. And Greg, I will be covering that strategy here in 2 weeks' time when we talk about this. If there's a market crash, will selling cover calls put me at extra risk? So no, cover calls will actually put you at less risk if there is a market crash, because the premium that you collect on the cover call will provide a little bit of downside protection. Not a lot, but 1 to 2% means that you are basically losing 1 to 2% less in a market crash if you sold a cover call versus not selling a cover call. But you certainly are not at extra risk. With that covers the questions that I have time for here today. I hope that this was helpful in giving you a better understanding of these strategies. I encourage you, for those of you that are new, to take the time to watch the recording. Make sure you understand these concepts before you start implementing them in your own account. And for those of you, once you've taken the time out to trade a few of these strategies, I also encourage you to come back and watch these recordings, because I do find that they will likely have a new meaning to you as to some of the things that I discussed here today. So with that, thank you so much. I hope you guys have a great trading day, and I'll see you guys next Tuesday on our options market outlook session every Tuesday morning. Thank you and have a great night.